On Sunday, Bitcoin plunged by more than 4%, a drop in cryptocurrencies that we'd been warning about weeks in advance. And all this is happening at a time when the probability of a broad approval of cryptocurrency ETFs has climbed to over 90%. So what can we expect for the price of Bitcoin and the wider crypto market after such a dramatic fall? Let's take a look. First, the good news. The odds of a cryptocurrency ETF approval in the United States have risen to 90% or higher. And we're not talking about just one ETF here. We're talking about an entire wave of crypto products that are all but certain to debut on the stock exchange as ETFs. That said, Bloomberg reports that the exact timing of these approvals and product launches remains uncertain. They speculate the process could take several months and potentially extend beyond October. Nevertheless, there's no question that all of these ETFs will eventually be approved. Take a look at the odds for the 2025 ETF approvals. They're insanely high, sitting at 95%. That's basically because the SEC has become a pro-crypto regulator. We're talking about ETFs for Litecoin, Solana, XRP, Dogecoin, Cardano, Polkadot, HBAR, and Avalanche, with SUI remaining the wild card at about a 60% chance of approval. But as you can see, we already have Bitcoin and Ethereum ETFs. It was a tough battle to secure them, yet now it shouldn't take much effort to usher in this new wave of crypto ETFs. That's obviously a huge positive for the crypto ecosystem. It's worth noting that active managers are aiming to replicate the success of the spot Bitcoin ETFs, which saw demand far exceed expectations in their first year and became the most successful ETF launch ever in the US. That's no understatement. Here you can see the cumulative total inflows into the spot Bitcoin ETF. Just look at it. Since day one, it's been smashing historic records again and again. This is a very good sign, a clear symptom that institutional interest in long-term Bitcoin investment is on the rise. It isn't a product launch that's failed in its attempt, at least not so far. Everything looks promising for the long term, and hopefully we'll be able to say the same about Bitcoin's chart and the broader crypto market. As you've seen, since the last major high, Bitcoin has already suffered an 11% appreciation. On Sunday alone, we experienced the very bearish climactic action we'd been anticipating over the past few days. Notice how after hitting the institutional target of this accumulation phase, a very typical move, it became the inflection point that triggered the bearish climax we were desperately seeking. From that reference point, the drop amounted to 7.71%. That 7.71% decline occurred between Friday and Sunday, but the real crash happened on Sunday when we saw a fall of over 4% in just one day. And again, that's no small matter. In previous videos, we explained why this bearish climactic action had to come, and once the price reached around this level, that's exactly how we broke it down for you. You see how we had an upward migration of the poke not once but twice, and on this occasion, that migration held right at the same price. Here, buying strength was calling the shots and taking control of the market, but then notice how the poke migration dropped, only to be matched again, and even now, still unfolding, they're equalizing it. That by itself shouldn't alarm us or signal anything dire since we're in a defense zone. The poke migration alone doesn't warn us of trouble. Price could dip here, create a fresh poke to gather strength, continue migrating, and push higher. So there's really no issue there. But what is the real problem? It's these two Bitcoin price rallies that have failed spectacularly. Why? Basically, we began with the POC at the $104,800 level. Right here, at a time when investors tried to find value at higher levels, we see that the time window was so short they couldn't lock in value where they once had it. That's key. When they revisited those zones, they were immediately rejected, unable to preserve value for a continuation upward. Why? To return and find value at the previous point of control. Here again, buyers got one more shot. Price ticked upward, but this time the window was absurdly brief and blink, and they did manage to find value. The alarming part is that price found value a third consecutive time at the very same control point. What does this mean? It means that on both attempts to attack these known value zones, where volume had once comfortably accumulated, they were flatly turned away. Why? To signal that Bitcoin's real value lies at lower price levels. In other words, there's no willingness to transact here. Everyone prefers to trade down below where value truly resides. And this is exactly what's being said. Now, I'm taking you over to a regular chart to make it clear. What I'm telling you is that this impulse could have its mirror move here. There's the massive Bitcoin collapse that could happen. Why? To hit the defense zone, which in itself isn't the end of the world. Even if they want to set a trap, frankly, it would be fantastic. Wouldn't be the end of the world, because at Crypto Insight, we remain positive. But we do acknowledge and believe that a bearish correction could come in Bitcoin and across various altcoins. You've already seen how we lived through that big bearish climactic action that cleaned out the last low. Very plausible, very expected event. Now, I imagine you're wondering, so what should we expect next? Well, honestly, we already explained it in the last video. However, with more data coming from Bitcoin after this big drop, we can now assess the next step in greater detail, and I'm about to explain that to you. But first...
Welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
First, let's look at Bitcoin's daily chart. This is crucial because we've adjusted the defense zone. We've become a bit more demanding about a potential recovery. And honestly, I'm not ruling one out since this big drop was expected based on the analyses we've been doing for weeks. What should come next is a rebound. That said, as I mentioned, the defense zone used to sit lower around here, but now we've moved it up to a level that the daily chart, and only the daily chart, clearly shows as the area they've really been defending. In itself, that setup screams trap, which would be a dire omen for a sizable bearish continuation. Truth be told, I can't say whether we're headed for a massive crash or a strong bullish recovery. What I'm going to share with you are the tools and mechanisms we can use to track both of those scenarios. And of course, I'll tell you which one we think makes the most sense. So keep in mind, we're still in a trap scenario, absolutely. No one can take that away from us. We're on the verge of saying, hey, maybe this is a trap. Now, we'll dig into volume and we'll be able to confirm the trap hypothesis as soon as price reclaims key structures. In other words, we still fully regard this as a potential market extreme. Of course we do. And not just in Bitcoin, we're seeing it in Ethereum quotes too, where the crash was even more pronounced. Just as we anticipated, we've been studying this as a distribution process on the 4-hour chart where price delivered a true black swan event. Without hesitation, institutions moved straight for their first institutional target. Remember, big players set one-to-one targets. The size of the distribution range projected one-to-one lands right at the price where Ethereum has now reacted. That's where institutions are booking profits on this entire sell-off. And what does that mean? It means that eventually, why not? We could well be staring down a market extreme here too. They went after their first institutional target. Maybe that's enough for them. Honestly, just looking at Ethereum in isolation, you can't draw any rock-solid conclusions. Fortunately, we know how to measure institutional distribution targets from the smart money, so at least we have a structural framework. Otherwise, we wouldn't have any price structure to talk about. But some assets make this a lot clearer. Take XRP on the daily chart. Even the 4-hour would tell you the same story. Remember in earlier videos when I said it was weird that price kept stalling here on XRP? I thought, how could they not want to test that macro defense zone? I fully expected that sooner or later, XRP would dip down to that gray rectangle you see below, the big support area. So if we switch back to the daily time frame, you'll see that the institutions holding long positions throughout this rally are still defending XRP's price. Notice how in these zones, they're protecting the price, refusing to let it crash, accepting and tolerating only so much. A small trap is acceptable and tolerable, but look at how they come right to that key area. Again, we could be at a market extreme with XRP. It's very similar to what we're seeing in Bitcoin, and coincidentally in Ethereum's hunt for its institutional target as well. Of course, none of this guarantees that price will simply turn around and head upward, despite that being the speculation weeks ago that we needed a bearish climactic action, which we ultimately got, before a rebound. What it objectively tells us is that we may indeed indeed be at a market extreme. That's crucial information, and it carries real weight. And with Solana's chart, it's more the same. We could clearly see that Solana was one step away from testing its macro defense zone. That's why we were also expecting a drop in Sol's price. And right now, we're in the defense zone, which, as long as it isn't decisively breached, lets us keep believing that Solana's buying power, really the crypto buying power in general, is still defending the bullish case. I'm sure you're following along. Now, take a look at BNB's chart. Around the $636 $5 level, we had what looks like a creek that was broken. They might have been working a flat pattern that failed to break out, which would have given us an immediate bullish continuation. But here's the interesting part. That bearish climactic move went straight for the area of highest trading volume across the entire range. That could very well be a classic liquidity hunt within a larger accumulation phase. In other words, many times after breaking a creek before shooting to the moon, they shake things up, scare people, go fishing for counterparties in a zone where institutions know there's heavy trading interest. And we can see that in the volume odd and liquidation maps that nobody really knows the source of. It's the point where, interestingly, the smart money went hunting, and that's where price stalled, in line with the broader crypto market. All this coincided with Sui's price action, where we also needed to see declines, and we're speculating that price might revisit the origin of that descending wedge breakout. Notice how in this massive drop, perfectly synchronized with Bitcoin, Ethereum, XRP, and BNB, Sui too printed its own structure but delivered exactly the same message. We could very well be at a market extreme. What Sui is telling us, just like other assets I haven't mentioned yet, is that if they really wanted to, they could form one last final bearish trap, an ultimate shakeout, before eventually turning things around. That possibility still exists. We might see trap after trap, bearish moves, sure, but don't worry, I'm going to give you a control mechanism based on order flow charting, so you'll know when to get bullish and prioritize longs in the short term, or when to suspect another bearish trap, and I'll explain that right now. First, I want to introduce you to our private Telegram channel, which is completely free. In fact, at the time of recording this video, we're also live streaming for the community. During these live sessions, we look for trading opportunities in the futures market. We focus on intraday trades, and within this community, members also share their operational ideas, what they're working on, and what they're looking for in the markets at any given moment. It's honestly very interesting. This community is constantly learning and improving. So if you're an active trader and tired of trading alone, you can join our community. It's very simple. The requirements are as follows. You need to be a user of BitUnix or BuyDFI, have deposited cryptocurrencies into your BitUnix or BuyDFI accounts with a minimum value of $100.00, and use this account as your primary futures trading account. In other words, you need to be actively trading. Once you've met these requirements, simply fill out the form displayed on the screen. It consists of just 5 simple questions, and we'll get back to you as soon as possible. And what better time to do it than now? Our friends at BitUnix have set up an exclusive promo for new users where they'll cover up to $100.00 in losses. So if this is your first time trading and you're looking to join the Crypto Insight Premium Telegram channel, you might want to take advantage of this safety net in case of potential losses. Remember, BitUnix is an exchange that doesn't need a VPN to be accessed from anywhere in the world. To make things easier, I'm leaving you the BitUnix promo details and the Crypto Insight Premium access form in the description and pinned comment of this video. Back to Bitcoin. What we're going to do now, and this is really interesting, is analyze how this drop was auctioned, how this climactic move was handled in the market. We're going to try to answer whether we can trust this plunge or if it might actually be a trap, and how we can navigate it. To set the stage, you're looking at bearish climactic action right here. Let's zoom in a bit to break it down. As I was explaining, we're going to see how the move was auctioned, what happened during the sell-off, what the institutions were doing, what the retail traders were doing. So here, price creates a black swan move, and then the massive crash hits. Notice how in that powerful candle where it all begins, we see buying at the bottom. We call this stop volume. It's a tactic used by the smart money, the big funds, where during a major collapse, they inject buy orders to slow the fall and then turn the market around. We're talking about that initial stage, and here you can see the institutional buys in green. Then price continues to fall by inertia, where again we spot buys, a red candle that's really tinged with green, and once more we see even more buying. Notice how during the massive collapse at the bottom of the drop, we observe aggressive market buys. These buys are so forceful that even after a trap, the buying reappears, and those purchases actually push price higher. In other words, Bitcoin's climactic sell-off has been bought, and after this deceleration phase where the big institutions keep buying, we reach a point where we can observe a micro creek that's pierced by a black swan move. Market buy orders show up, active buys that drive the price upward. What does this tell us? It tells us that in an eventual scenario where Bitcoin and the broader crypto market are in a hurry to rally, institutions really wanted to push price higher around this level at about $100,250. Bitcoin would be defended. Keep this message in mind. I'm not guaranteeing this will happen. I'm telling you that if the major investment funds decide to apply tremendous bullish force and immediate directional conviction to the market, they wouldn't allow price to break above this structure. It would gain a lot of fuel here and take off in a bullish trajectory, nullifying the trap we're seeing. And yes, traps are possible in crypto markets because we've seen in different assets how, if they really wanted to trap us, they could. This means that this same level can also serve as a prelude, a warning, an indicator. If price does break above it, we likely see macro level wipeouts below, and that wouldn't necessarily be excessively negative for the crypto market. Now on screen, you're seeing Ethereum's massive crash. Absolutely wild. We're going to do the same exercise we did with Bitcoin. Analyze how this drop was auctioned. What were the big funds doing at the same time that retail traders were acting? Here you're seeing the first big warning. Sales show up. Look at the volume and the delta. There's been massive panic and fear to sell Ethereum. That makes sense because retail traders see price crashing, and once Ethereum has plunged with strong momentum, they rush in late, because they always do, and start selling. But those sales don't actually move price anywhere, so all that selling was also stop volume, just displayed differently. In fact, when price retested, notice how this buy comes in, an order that at least temporarily is strong enough to hold price up. That too is stop volume in broad terms. But now let's see what happened next. It's really interesting to know exactly what just happened with price so we can assess what might come next and why understanding this is so important. Notice another collapse here where we see a complete jumble of buys and sells. Pay particular attention to the predominant cluster, ABIT cluster, and actually look at the delta and the volume on this candle. There is massive transactional interest, yet this sell-off fails to gain traction. It's completely halted. Price then moves sideways in a ridiculous range to create a climactic action, the trap of the trap, where the retail investor bought into it and tried to sell, as you see. But this selling goes nowhere. The most important takeaway is recognizing that there are trapped shorts in Ethereum. And if shorts are trapped in Ethereum, they're trapped across other crypto assets too. That's why, just like with Bitcoin, we've been hunting for key levels. To me, this stop volume, the selling that initially looked like a runaway success, has left anyone who didn't close at break even suffering horribly. As soon as price eventually comes back to test that structure, all of those sell orders will flip into buys, exerting bullish pressure on the level. I'm talking about the $2,202 price zone. That's why, just like with Bitcoin, we can say that if these trap shorts are going to be used by the big funds to trigger a stop loss cascade, they won't wait long to push price up. And what level are we talking about? I just told you. It's the same approach I showed with Bitcoin, now applied to Ethereum. If you see Ethereum fail to break that structure, it's likely we'll get strong bullish momentum. Those shorts will be squeezed out by stop losses, and price will rocket higher. Spectacular. Conversely, if we see those levels decisively broken, price breaches that structure, then we'll probably revisit recent lower levels in search of trap of the trap setups. You see how crucial it is to understand these levels? They'll guide us in maneuvering in the short and medium term. But tell me, what do you think? Do you believe we're at a market extreme and will either quickly rally, option 1, or set a final bearish trap before reversing, option 2? Or do you think we've entered a full bear market and are headed for disaster? Leave your thoughts in the comments. And if you enjoyed this advanced technical analysis, hit like, subscribe, and click the bell so YouTube notifies you of future videos. Good luck with your investments, and see you next time.